Healthcare REITs. We're going to go through some of the options today and look at some of the biggest and the bestest healthcare REITs, real estate investment trusts, to try and determine which set of them might be best for you and your needs today. So stick with me, people, and let's get into it. Right, so this is only those on the New York Stock Exchange or the Nasdaq. We can see here some of them have credit ratings and some do not. Now I'm just going to take a couple of minutes. At the moment they're listed alphabetically by ticker, but I just want to get a bit of a sense of what's going on here. So we have some here with credit ratings. They're not into the A's, so they're not the worst credit ratings, but they're also sort of not the best either. We have a range for long-term debt capital ratios from about 40% through to 60%. So obviously I've seen higher, and they seem to be quite constant. The dividend yield varies between about 3% and several options here with about a 9% dividend yield. Current weighted average cost of capital from about 1.8 through to about the 7s here. The price by AFFO ratio, which is kind of like the PE ratio for REITs, ranging from about 9 through to the 17s and 20. And dividend per share compound average growth rate over 5 years, ranging from those with reducing dividends through to those growing them by as much as 7 to 9%. So let's have a look and see which one of these might be some good options for us today. Subscribe today and become a better dividend investor tomorrow. Okay, so what I want to do first of all is I want to go through quickly some of the historics. This is looking at the price to AFFO, the adjusted funds from operations ratio for the companies. That's essentially the same as the price to earnings ratio. I'm just going to go through these quickly just to get a sense of what they look like historically. And we can see the first option has some good growth. The second option appears to have a bit of a wonky start there with a high dividend yield, and that sort of evens out to be a bit more reasonable with some growth there. Moving on to the next one, we can see some strong growth at the start and then it seems to be fairly stable. Some strong growth here at the start and then some stable growth now at the present. So some sideways movement there, not a lot of growth. Some growth in the past that's sort of been coming off the boil a bit since the pandemic. More or less going sideways here on this option as well. Some reasonable growth here with NHI, National Health Investors, both in terms of the AFFO growth here each year as well as in the dividends. Omega Healthcare, strong growth up until about 2016, and then it's gone sideways in terms of AFFO growth. Health Peak Properties, so sort of going sideways through to about 2016, then it's sort of dropped off quite a bit, both in terms of AFFO as well as the dividends paid out. Sabra Healthcare, so sort of going up till about 2016 and then a steady decline both in AFFO as well as the dividends being paid out. Universal Realty, Universal Health Realty Income Trust, so a bit of a data blip there. Ventus, so sort of going up again to 2015-16 and then a decline with an expectation here of some increases in the future. Quite a sporadic change here also in the dividends. Welltower, so some steady growth here, quite a tight looking range of dividend payout ratio here based on AFFO, with a bit of a decrease since the pandemic, with it looks like an opportunity here to grow the AFFO quite a bit in the future. Have a quick look now at the forecast returns to sort of see what the sense is here in terms of what might be gained. I'll be looking at the end of 2024, giving us the best estimate coverage, or sorry, the analyst coverage for estimates. We'll also be looking at here, for example, the slight decrease in AFFO estimates over the last 6 months, 4% dividend yield, relatively small company, and 40% debt to capital ratio. Here looking at about 19.4% per annum return is possible if prices move upwards and hit the same ratio that they've seen in terms of price to AFFO over the last 5 years. About a 13.6% return with Care Trust. The AFFO estimates have slipped reasonably in the last 6 months, so a bit of a slip there. 5.3% dividend yield and a double B S&P credit rating. So here we can see almost no change in the AFFO estimates, with a reasonable 17% return expected if prices return to this price to AFFO ratio, with a 5.6% dividend yield. This is based on a reasonably strong 19 times price to earnings ratio and also a triple B credit rating. About a 31% return here per annum. Now this is a relatively new company, so there's not a lot of data here to calculate the normalised price to AFFO ratio, but 15.89 seems reasonable. Noting, however, it is a rather small company with under $1 billion market cap, and as we can see here in the estimates over the last 6 months have been weakened somewhat in terms of the AFFO and revised downwards. So keep that in mind, but it does have a nice 7.7% dividend yield here, with some expectation, at least over the next several years, of relatively small increases in the dividend. Next on the list, we have Healthcare Realty Trust. So looking at about 23% return, a little bit of slippage here, I think, in terms of the AFFO estimates. We can see about a 6.7% dividend yield. I think the dividend yield here is also quite close in terms of the payout ratio of about 94.5%. And again, we see this as a reasonable market cap, and it has a moderately good long-term debt to capital ratio, but also quite a high price to AFFO ratio. LTC Properties. So, looking at about 15% return per annum. The AFFO estimates have slipped a little bit over the last 6 months and revised downwards somewhat. The dividend yield here is about 6% expectation. And a $1.5 billion company, so relatively small market cap, and slightly elevated debt to capital here of about 50%. Medical Properties Trust, looking out, we can see again a small revision downwards in AFFO, looking at potentially a 38% annualized rate of return. That's primarily because of the recent issues that we've had regarding the steward, the largest tenant, and the concentration risk here, with about 30% of their rent coming from a single tenant. More videos on that. There's a link down below to get a little bit more additional coverage on that. Because of the relatively low prices here, we're looking at about a 9.1% dividend yield, and no real expectation here, I think, from analysts or most investors, that the dividend's going to be increased in the near future. Now, it is BB plus rated, and it has again about a 50% debt to capital ratio. NHI. So, about a 17.1% annualized rate of return. There's been quite a strong revision downward here in terms of the AFFO in 2024 and also in 2023. It does have a nice 6% dividend yield, and it looks like there's an expectation here, at least by 2024, of some increase in the dividends. BBB minus credit rated, with a roughly 46% debt to capital ratio. OHI, Omega Healthcare Investors. So very little here in the way of annualized rate of return, 13%. This is primarily going to be driven by the 9% dividend yield. And again, we can see relatively stable AFFO with a little bit of a downwards revision over the last 6 months. And essentially no expectation here for dividend growth from analysts either. So triple B minus rated by S&P, and quite an elevated, I think, 60% debt to capital ratio. Healthpeak Properties. So an expectation of about 9% return per annum. Again, AFFO estimates have been revised downwards over the last 6 months. We're talking about a 4.4% dividend yield, with some potential here for some increases in dividends until 2024. Triple B plus credit rated, so quite a good strong company here, with about a 50% debt to capital ratio. Sabra Health. 12% rate of return per annum is expected and forecast. Again, AFFO estimates have been revised downwards over the last 6 months. 9% dividend yield, so not too bad. BB plus S&P credit rating, and quite a strong 44% debt to capital ratio. And most of that annualized rate of return was going to be driven by that strong dividend yield. Ventus. So here, this is probably one on the list where the once again the AFFO has been revised downwards over the last 6 months, but because of the relatively high prices compared to the historic price to AFFO ratios, even with relatively strong AFFO growth going forward, we're still looking at, if prices revert to this 16.6 times price to AFFO ratio, we're looking at actually a very, very small annualized rate of return here as a loss. But this is a strong company, BBB plus, and it does have a reasonably high 53% debt to capital ratio, and the dividend yield is only 3.5%. However, if we look down here, we can also see that there is an expectation by analysts that their dividends will be increased over the coming years. And again, it's got quite a nice estimated payout ratio of about 71% at the end of 2024, and about 73% dividend payout ratio now in terms of AFFO. I'm going to quickly flick through the analyst scorecard to get a sense of which of these REITs the analysts are reasonably good at forecasting, and which of these REITs are giving a good guidance to the analysts. So I'm just going to flick through, and we're just going to keep an eye here on the 1 year forward with a 10% margin of error, as well as the 2 year forward with a 20% margin of an error, and we're looking here at the AFFO estimates. And just flicking through, looking perfect here on this one. Not so good with the DOC. GMRE looks good out for the 2 years estimate. There's not very much data for that though, being a relatively new REIT. Healthcare Realty Trust looks to be reasonably easy to estimate. LTC reasonably stable here with a 2 year forward. MPW, some challenges there in the 2019 lately, and so some challenges there in the 1 year forward estimates, reasonably accurate with the 2 year forward. NHI, some beats here the 1 year, and pretty much stable in the 2 year, so reasonably good estimates for the 2 year forward. OHI, reasonably good here with the 2 year forward, and reasonably good with the 1 year forward also. Health Peak Properties, reasonably good 1 year forward with some problems in the 2 year forward. Reasonably good 2 year forward and 1 year forward for Sabra. Universal Health Realty Income Trust doesn't really have a lot of data, but looks fundamentally good from what we can see there, and easy to forecast. Ventus has some challenges there, missing it about 17% of the time at the 1 year forward, and about 8% of the time with the 2 year forward. Welltower, the last one. Again, missing it 17% of the time 1 year forward, and about 17% of the time also with the 2 year forward. Okay. So which of these options might suit different types of investors? Well, long-term investors closer to retirement might be quite attracted to BBB plus credit rated, so investment grade credit rating here. There's 3 options. However, when we look at each one of these options, they have also been cutting dividends over the last 5 years, which is important to note, and they also have relatively low dividend yields here. But at the same time, relatively safe debt to capital ratios here, I think, for a REIT. However, if we step down a little bit here, Physicians Realty Trust, BBB rated, a very small amount of dividend growth over the last 5 years, reasonable 5.8% dividend yield, and a reasonably solid debt to capital ratio here. National Health Investors, BBB minus, and Omega Healthcare Investors, also BBB minus. Omega's got an elevated debt to capital ratio, but also a very high yield, and a history here of increasing the dividend a little bit. If you're prepared to be more speculative, I think going down the list here, I would potentially be looking at a Global Medical REIT. The debt to capital ratio is a little bit elevated, but it's got a good dividend yield of 7.7% with some long-term growth rate. Healthcare Realty Trust, 43%. Debt to capital ratio looks pretty solid, and the dividend yield here as well as 6.7 looks nice, and a reasonably strong 5-year compound annual growth rate for the dividend. Now again, this is not providing investment advice, this is just highlighting some of the options that you might want to look at for your own investment portfolio. But absolutely you need to go away, you need to do your own research, and you also need to work out which one of these options is going to be the best possible fit for you and your investment objectives.